Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. So many things affect real estate values, and one of the big ones is the Federal Reserve's policy. What do their latest moves mean for real estate investors? That's what we'll discuss today, and we have an awesome guest on the Real Estate Guys radio program. In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining us this joyous season, it is our co-host financial strategist, Russell Gray.
Hey, Robert.
Happy end of the year, happy beginning of the year, wherever you're listening and whatever time it is. It's a new year upon us, and we're excited about that. Happy holidays to you and yours. We thought this week we'd bring you a little bit of news, if you will. Not exactly clues in the news, but every now and then we get the news from the Federal Reserve. And I guess before we talk about the news, Russ, let's talk about why it is, as real estate investors, that we pay so much attention to what happens at the Fed.
Well, the Fed really controls the price of money, and we all earn, spend, pay taxes in, denominate our wealth, borrow in dollars, and they really control the price of all that. They either expand or recede the money supply and try to manipulate markets and behaviors. They're in cahoots, if you will, with the politicians, and they're supposed to be independent, but I think that facade has fallen. So we've been in a system of fake money or fiat money since 1971 when Nixon took us off the gold standard. And really, effectively, we've been off the gold standard for quite a bit longer than that, going all the way back to the Depression. So the Fed is the major player, the 800-pound gorilla, the elephant in the room that everybody has to deal with. And of course, markets are very sensitive to Fed policy. So if you are active in volatile markets, fast trading markets like the paper market, stocks, bonds, then you pay very close attention to what the Fed does, and you try to catch those movements. But it also affects slow-moving real estate because it affects things like inflation, employment, cost of borrowing, cost of interest rates on mortgages. All of those types of things are affected by Fed policy. So real estate investors need to pay attention too, especially when it begins to affect employment. A lot of people pay attention to the mortgage side of things, but employment is a big side of it because obviously people can't pay rent if they don't have jobs, or if they have jobs, but the jobs don't pay enough in real wages because inflation, the cost of gas, the cost of food, the cost of things people really need in the real world have gone up so much. And we've seen a lot of that for the first time in many decades, serious inflation. And so this is really putting all eyes on the Fed. What are you going to do about it?
Well, and to that end, they meet quite regularly. And in anticipation of that, there's all kinds of news. Afterwards, there's all kinds of news. Let's cover what just happened because we want to pay attention, and it's not the same old story. There were a couple of, I won't call them unexpected, but a couple of maybe not everybody was on board with the direction that the meeting took.
Well, the context is this. The great financial crisis, what we call the 2008 financial crisis, really manifested in the credit markets because a few subprime borrowers defaulted, and that caused some mortgage-backed securities to underperform. And when that happened and they got marked to market, meaning the price of the securities went down, those margined securities triggered margin calls, panic selling, and all of a sudden a market in free fall that nearly took down the entire credit markets. And we've talked about that many, many times on this show. And yet that's a lesson that I think a lot of people need to understand. And so the result of that was the Fed taking its balance sheet from $800 billion, which is what it was entering the 2008 crisis, all the way up to $4.5 trillion. That is a mega expansion of the amount of money out in the system being circulated. And the primary primary purpose was to reflate the stock market, to reflate the bond market, to reflate the real estate market. And how do they get the money into the market? By making monthly purchases. And so they're purchasing $80 billion a month or $1 trillion a year of treasuries, and another $40 billion a month or $500 billion a year in mortgage-backed securities. And that's been going on for a long, long time, a decade. And so the concept of tapering is the idea that, hey, we're going to slow that down a little bit. We're going to stop expanding our balance sheet, which has swelled from $4.5 trillion at the end of the financial crisis all the way up to close to $9 trillion today. So it's doubled. And the question is how big can that thing get before people begin to lose faith in the currency, and what are the Fed's options? Well, if they raise interest rates, then that really collapses the bond market, which is the financial system, just the same way that if cap rates on apartments go up, it's a reflection of the bid on apartments going down. In other words, your equity's disappearing if the cap rate is going up, not because of rising rents, but because of lowering prices. Well, same thing's true in the bond market. So if the Fed raises interest rates, it collapses the financial system. So it's like, okay, well, I can't do that. But if they continue to print money to prop up the financial system, well, then that begins to dilute the dollar and it shows up with inflation. Well, up to now, they've been able to suck up all that inflation, if you will, by really stealing the productivity gains, which we can spend a little bit more time talking about if we have time. But they're not able to do that anymore. And inflation has shown up in the real world. And now it's on Main Street where everyday voters, everyday consumers are feeling it and they're upset. And now, to quote our good friend Peter Schiff, the Fed finds themselves in a monetary policy Roach Motel, right? They got into a situation, they can't get out of it. And so the question is now, what are they going to do? They've been jawboning about how they are willing to step in and fight inflation if and when it shows up. Well, it's here. And the Fed actually had to come out and admit, hey, this isn't transitory. Looks like it's going to be around for a while. So that's really okay. Then what are you going to do about it? And I think, they're in a no-win situation. No matter what they do, it's going to be problematic. So we have to not try to predict what they're going to do. We have to anticipate what all of their options are, think about what the ramifications of those decisions and actions would be. And we can't just listen to what they say. We have to watch what they actually do. And then we need to be prepared to pivot in whichever direction. And whereas paper asset investors can pivot quickly, real estate investors have to be a little bit more forward thinking, because even though the results of what they do roll into real estate more slowly, our ability to react to them is also slow. And so if we're behind the 8 ball, sometimes we can get steamrolled. I know that's what happened to me personally in 2008, which is why I'm so adamant about making sure people understand this today. And I think that now is a time that more than ever, people need to be paying attention to the Federal Reserve, even real estate investors.
A few months back at our investor summit, Dr. Doug Duncan, the chief economist for Fannie Mae, did a talk on this very thing. And is the inflation transitory? And his conclusion was, not really. I mean, there may be some elements that are a bit transitory, but he wasn't buying the line. He's a pretty smart dude. And then, of course, Robert Kiyosaki, Ken McElroy also chimed in on that, as did George Gammon. Absent from the summit at the last minute was Peter Schiff. And so we're going to spend some time with our good friend Peter today. He always has an opinion when it comes to this stuff. We come back, we'll say hi to Peter Schiff today on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Garrett Sutton, Rich Dad's advisor. Remember, equity happens, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com. We're talking about the latest moves from the Federal Reserve, what that might mean for real estate investors, and the gentleman you're about to meet has a thing or two to say about that. Please welcome back to the Real Estate Guys radio program our good friend Peter Schiff. Hey, Peter.
Hey, Robert. Thanks for having me back on your program.
Always good to have you on, always illuminating. We turn to you, of course, when there's news about the economy, and the Fed came out and said, we're not buying bonds. There's going to be, some raises over the next 6 to 8 months. Before we talk about what that might mean to real estate investors, give us your take on, what the Fed has indicated and what you think might really be the deal.
Yeah, you introed by talking about some of the moves the Fed has made. Well, the Fed hasn't actually made any moves. It's talking about making moves, but it's still doing what it's been doing, which is continuing to print money, buying U.S. government bonds, and it continues to hold interest rates at zero, despite the fact that it's now reluctantly had to admit that it was wrong about inflation being transitory. Even if you look at, or believe rather, the government's own numbers, which I don't. I mean, the numbers are not nearly reflecting what's happening to goods and services that they're purporting to measure. But if you accept the CPI on face value, if you annualize the first 11 months of this year, you're at 7.3% price increases. Now, maybe the Fed was able to justify 0% interest rates when the CPI was under 2%, and they claimed that that wasn't enough and they needed to get the rate back up to 2%. Well, now that we're almost quadruple 2%, what is the justification for continuing to hold rates at zero? So they should be raising rates right now. They shouldn't be talking about raising them at some point next year. And what they definitely shouldn't be doing is pouring even more gasoline on a fire that they lit by continuing quantitative easing. They're claiming, well, we're going to slowly taper off the amount of gasoline we're pouring onto this fire. Well, if your goal is to put out a fire, pouring less gasoline on it isn't going to work, right? You need to pour on water or something like that. And what they need to do is shrink the balance sheet. They need to reverse the quantitative easing that they've already done because they did way too much. But the Fed is not doing any of that. The Fed is simply hoping that talking about pouring less gas on the fire in the future will make the fire go out. But it's not going to happen. Inflation is going to keep getting worse and worse. And yes, that has implications for all sorts of asset classes. But if the Fed was actually committed to doing what it's pretending it's going to do, that might have the opposite implication for those asset classes.
Yeah, that's a great point. I mean, as real estate investors, obviously the fuel we use to buy investment property are mortgages, and the interest rate that we pay, which isn't exactly the same as the Fed interest rate, obviously, but it's certainly influenced by that. We want to see that there's going to be a ready supply of capital, and it's going to be at a good interest rate for us to feel bullish on the markets moving forward, which actually is a separate discussion. But time and time again, the Fed comes out and they say something. And you were talking about this 6 months ago about it's not transitory. Who are they fooling? They're going to have to admit it someday. And even then I thought, well, they're not going to admit it. And yet they just basically did. They basically said, well, okay, so we were wrong. It's not transitory. So now you're saying you're not sure they're really going to follow through on what their intent is right now.
Well, think about it. When the Fed thought inflation was transitory, what was its plan for transitory inflation? Well, it was to taper their QE program, to finish the taper around May of next year, and then potentially raise interest rates 1/4 of a point shortly thereafter, and maybe raise them again before the end of the year. So the plan was to taper QE and get interest rates up to about 0.5% by the end of next year. Now they've admitted, okay, we were wrong. We have a problem on our hands. It's not transitory. So what's their new plan? Their new plan is to taper QE, but finish the taper in about March. And so maybe we'll have the first 1/4 point rate hike in April instead of June. And maybe by the end of next year, instead of raising rates to 0.5%, we'll raise them to 0.75%. I mean, that doesn't make any difference. So basically the difference between we have no inflation and we got a big problem is an extra 1/4 point rate hike next year. I mean, that is irrelevant to the severity of the problem. So even though the Fed has admitted the problem, they've barely done anything to adjust their policy in light of this new information that they now have. So you can't believe what they're saying because their actions don't match their rhetoric. Yes, did they tighten in a sense that they made ultra loose monetary policy slightly less loose? Yeah. But if you have an inflation problem, you need tight money. Less loose money is not going to cut it, right? You're still going to be fanning the flames of inflation with that policy.
So, Peter, when the Fed is looking at trying to curb inflation, which they say is one of the things that they're supposed to do, keep it within this, 2% a year limit, you've been pointing out that no, annualized, it's a lot more than that and has been for some time. We'll see at year end what it looks like for 2021. And as we look forward to the new year, they don't have that many tools in their toolbox, it seems like.
Well, they don't have any tools that they're willing to use. I mean, I said, what if you have a headache and the only tool you have is a revolver? It'll work. You won't have a headache anymore if you pull the trigger. But, you're not going to kill yourself to get rid of your headache. And that's basically the way the Fed is going to look at it. Yeah, we can stop inflation, but at what cost? Because I think the Fed thinks that the cure for inflation is worse than the disease of inflation, which is why the disease is going to get much worse because they're afraid of the cure. Now, I disagree. I think the cure is not as bad as the disease. But in the short run, yes, for a lot of people, the cure is much worse. Particularly, you're talking about real estate. Real estate in particular would collapse in an environment where the Fed were actually fighting inflation. Because, part of the inflation problem is real estate prices going up. That's a price that has been inflated, right, or moving up. So the inflation would want real estate to come down, right, to ease off that. But the way you fight inflation is you got to make interest rates high in real terms, and you got to encourage people to stop consuming, stop speculating, and to start saving. And so if interest rates had to go up, well, let's just say they went up to 5 or 6%. I think they'd go higher than that. Mortgage rates in that environment might be 7 or 8%, which, once upon a time, 15, 20 years ago, that was about where they were, right? We're not talking about the Volcker days where you had, double-digit mortgage rates, which is probably where they'd have to be to make a real difference. But if interest rates went up to that degree, there's only one direction that house prices could go, and that's down. because people buy monthly payments. They don't even necessarily buy the price. And if you take mortgage rates, which are now, 4% or lower, and basically double them, you're effectively doubling the cost of a house. Well, have people's incomes doubled? No. So if you double the monthly payments, prices have to get cut in half for people to be able to afford what they could afford before. And so if you're trying to sell your property, you're going to have to put it on a big sale for the buyer to afford it. But also, what happens when real estate prices really go down? Well, we know what happens. A lot of people that borrowed money to buy real estate when the price was high just stop making the payments when they have negative equity. And that just really increases the supply of property on the market. You have a lot of distressed sales, you have a lot of foreclosures. That makes the problem even worse. So a Fed that was committed to fighting inflation would destroy the real estate market. Prices would collapse, foreclosures, all kinds of defaults. Lenders would lose a lot of money. I mean, it's a great environment for real estate investors who have a lot of cash and now want to pick up a lot of those bargains. But if you're one of those leveraged real estate investors, you may go bankrupt in that environment, which creates, the opportunity for the people who, are flush with cash. But it's not just real estate investors. Lots of assets are sensitive to interest rates. The stock market is another example. If interest rates go way up, stock prices are going to go way down. Bond prices, of course, by definition, if you're sitting on a 30-year treasury with a 1.9% coupon and the treasury is issuing new 30-year treasuries at a 6 or 7% coupon, what's yours worth? It's worth a fraction of what you paid. And if you want to sell it, right, you're not going to get anywhere near what you bought. Now, of course, you can hold it for another 29 years to get your money back, but what will your money be worth, with inflation eating it away? So all these financial assets are going to get killed. So if you actually think the Fed is going to seriously fight inflation, you need to, sell assets, get liquid, get into cash, and wait for the collapse. But of course, if you're wrong and the Fed doesn't fight inflation, well, then you're screwed with a bunch of cash because inflation destroys the value. Because if the Fed just allows inflation to run uninhibited, then it's the dollar that crashes, not stocks, real estate. Although stocks and real estate may still crash, but not in terms of dollars. They crash in terms of gold, right? In terms of real money, you can see the price going down. So, gold might be a relative safe haven in either scenario, because if the Fed really fights inflation, gold will go down, but not as much as stocks and real estate. So you'll still be able to liquidate your gold and buy back more stocks and real estate than you sold. On the other hand, if we have massive inflation, then of course, gold's going to go up. It'll go up more than stocks and real estate. But the way a lot of real estate investors will end up making money in a highly inflationary or a hyperinflationary environment is not because they're landowners, but because they're debtors. It's the debt that gets wiped out, the money that you borrowed to buy real estate. So you don't really have to pay it back. I mean, you pay it back, but you're paying it back with chump change, right? Maybe, you borrow a bunch of money to buy some real estate, and then there's massive inflation. Well, you raise your rents, and now maybe with one month of rent, you can pay off all the debt that you had. Because, if there's hyperinflation, somebody's rent was $1,000 a month and you make it $1 million a month, right? I mean, if there's hyperinflation, and then if you have $10 million of debt, well, you just pay it right off, right? But the problem is, though, your mortgage might go away, but your maintenance costs won't, your taxes won't, insurance. So a lot of your other expenses are going to go way up. But your fixed rate mortgage won't if you have a mortgage that's fixed.
Excellent points, and definitely worth thinking about. It's been this interesting year or two because with inflation going up, what you mentioned, we see in pretty much every real estate market, prices are high, multiple offers, everyone's home is worth way more, the wealth effect. And at the same time, interest rates have been really pretty low. So if we're sailing into a time where that might change, it's definitely time to rethink not only your current portfolio, but anything you might want to accumulate in the future. And another aspect of that, Peter, is the fact that the logistics supply chain is so fouled up, and pricing on things like lumber and the components of property have gone up. That's also contributed to the value.
Yeah, I mean, first of all, if there's tremendous inflation, the cost of building new homes goes way up, not just the material costs, but the labor costs. And if there's shortages of labor, it costs more money to build. So that favors already existing structures because they've already been built, which is, I think, a good factor when you're looking at real estate, is to look at, the replacement cost too of the property that you're buying. Because if you're buying a piece of property for less than it would cost you to replace it, then at least you're getting a value. There's still parts of the country where prices are so far out of whack because of the supply and demand. I mean, that's also, people have to look at, that old expression, all real estate is local. I mean, you also have to be really careful about the markets that you're invested in because they could have very different outcomes in either scenario. But the economy, either way, is going to be very problematic, right? If the Fed fights inflation, there's a massive recession. If it doesn't fight inflation, there's massive inflation, which in many respects is worse than recession. In fact, it'll feel like a bad recession, even if the government doesn't admit it, because the numbers will still be high. But the deflator, will never be high enough. The government numbers are not accurate. And so we could be in a recession that nobody acknowledges because inflation makes it look like the economy is getting bigger because we're not measuring it accurately. But so you have to be very particular. I mean, look at where I am in Puerto Rico. It is, I don't know if you know what's going on over here, how crazy it is, but literally in the last year and a half, depending on the house you have in this community, I'd say your low end appreciation is 3 to 4 times and your upper end is 4 to 5 times. So I'm talking about buying a piece of property, doing nothing to it, just buying a piece of property and being able to turn around and sell that same property for maybe 4 times the purchase price. So you bought it for $2.5 million and then turn around and sell it for $10 million. And the people who are buying that house for $10 million, they're not even getting mortgages. They're like, I'll close in 30 days, all cash. I mean, nobody around here is shopping with a mortgage. Everybody's coming in, and there are houses that are now priced over $30 million. But this is like one little area, but part of it is the supply and demand because there's not a lot of supply. A lot of people want to move here. And if you want to build, it takes forever. It takes 3 or 4 years to build something. The material, and they cost a lot of money, the labor, the materials. So people are paying a big premium for a structure that's already been built because now they don't have to do it themselves and they're in a hurry to get over here. Right, because they want to start saving on their taxes. They don't want to wait for the house to be built, and they want to live in this particular neighborhood. So yeah, it's like that. I mean, in theory, not that I'm selling, but my best investment is my Puerto Rican real estate. I didn't move here to become a real estate investor, but I'm not selling the property. So in that respect, it doesn't necessarily make a difference. I'm just glad I moved here when I did. I can't afford to live here now.
You're tuned to the Real Estate Guys radio program. We're talking with Peter Schiff. More when we come back. Plus, we'll play real estate trivia, and you can win a copy of one of his books next. You're tuned to the Real Estate Guys radio show. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Registration is now open for the Real Estate Guys 20th Annual Investors Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning in 2022, the editor of the Gold newsletter, Brian London, international real estate developer Beth Clifford, the author of The Creature from Jekyll Island, G. Edward Griffin, Jim Rohn's 18-year business partner, Kyle Wilson, and the rebel capitalist, George Gammon. And joining us live and in person for his 10th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus lots more to be announced. It all begins June 10th, 2022 in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. Go to realestateguysradio.com, click Summit, and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 20th Annual Investor Summit on Sand.
Hello, this is Dave Lendiger, co-founder at RE/MAX International. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you've ever wanted to do bigger real estate deals using other people's money, or if you're a passive investor looking for great returns, then come on out to the Secrets of Successful Syndication. We do it twice a year. It's a 2-day event. The next one will be in Dallas, Texas in early March 2022. You can get all the details on our website at realestateguysradio.com under the tab that says Events. We're talking today about the latest Fed moves. Before we get back to our interview with Peter Schiff, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question, which is going to have something to do with Puerto Rico. And the prize is Peter's awesome book, The Real Crash. That can be yours if you know today's Real Estate Trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. We'll need your name, your answer to the question, and your physical mailing address. We can send you out this big old brick of a book, The Real Crash by Peter Schiff. Last week on the show, we were talking about breaking news when it comes to retirement account investing, and we asked this. According to a study released by Bankrate.com over the summer, which is the best U.S. state in which to retire? Well, according to the study, Georgia is the best state to retire, followed by Florida, Tennessee, Missouri, and surprisingly, Massachusetts. Maryland, on the other hand, held last place in the ranking. Here's our real estate trivia question for this week. Puerto Rico got its current name all the way back in 1521. What was it called before that? Yeah, the island nation of Puerto Rico was not always called that. In fact, it's had several names over the years. What was the name prior to Puerto Rico? If you think you know, or want to look it up, get your best guess to us at trivia@realestateguysradio.com. Send us your name, the answer to the question, and your physical mailing address. The first one that gets it right gets a copy of The Real Crash by Peter Schiff. That's today's real estate trivia question. Peter, before the break, we were talking about Puerto Rico and your point earlier that every market is different and all real estate is local. Here's a situation where an outside influence, basically the Title 20 and 22, the ability for people to set aside or to lower their tax by a ton, has brought people there for that reason. And as you've mentioned, it's not like it's an awful place to live. So you live in a beautiful neighborhood, have an awesome house. But meanwhile, the demand side is so high that there's nowhere for prices to go but up. And that's true in many markets.
And now supply is coming on the market. There are more houses for sale now all of a sudden than I've seen. So I expect some price declines because people are now looking at the price of their house and say, wait a minute, why don't I just sell? This is ridiculous. I'll move. I mean, I like living here, but that's a lot of money. But that's really what's happening is that super rich people are forcing out just regular rich people because they have more money to throw away. A lot of these people are coming from the crypto end of it, and they've got real stupid money, based on what's gone on there. And of course, it was the perfect storm for prices going up because there was also COVID that came, and everybody started working from home, and people were like, well, I don't have to go to the office every day. Well, I don't have to live here in this city, and not only were the taxes high, but I don't know if you're paying attention, but crime is exploding in major cities all around the country because the police aren't enforcing the laws. I mean, they don't want to be accused of being racist, so they don't want to arrest anybody who's committing a crime because, some of those people might be African Americans. So, we don't want to be racist. So there's all this crime. So you have high taxes, high crime, and I don't even have to leave my house So why am I living in a little apartment with no backyard?
Right.
And if I get locked down again, I'm cooped up. My kids can't go anywhere. So people are moving. And now, well, as long as I'm moving, why don't I just move to Puerto Rico? Because if I'm working on the internet and working on a phone, what difference does it make? I don't have to be just, in the country, an hour away. I could be, a 3 or 4 hour plane ride away in Puerto Rico. And so a lot of people that maybe wouldn't have even considered moving here pre-COVID, all of a sudden it was something that they could do. So, it really increased the demand. And, I think part of the value of the property here is the present value of those tax savings. It's like an ancillary benefit that gets priced into the home. It's like an extra bedroom or a new kitchen. It's like you get this tax savings as a result of living in that house. And of course, they also changed the incentives. You have to buy a house now to get some of these tax breaks. So you can't rent. You got to buy. But rents are going up too. It's not just, prices. I mean, rents have tripled. It's a lot. It's expensive to rent. By the way, we talk about the CPI. I think year to date, home prices are up about 20% nationwide. Rents are up maybe 15, 17%. But according to the government, housing costs, which they claim are rents, are only up 3.5%.
Right.
Wait a minute. How is that? And that's like a third of the CPI. And they're saying that third is up 3.5% instead of 20%. And that's because they don't use the rents that anybody actually pays or receives. They made up something called owner's equivalent rent. And what that is they just take a survey and they call up people at random, I guess. Although I've never received a call. I don't know what the criteria is, but they call some people up and they say, hey, if you were going to rent out your house, what do you think you could rent it for? And then the guy says, I don't know, $1,000 a month. Okay. A year later, maybe they call the same guy up and say, what do you think you could rent your house for? And he's like, I don't know, $1,000 a month. What does he know? He's not a landlord. He doesn't know what the rental market is. He just makes up some number. And so they write that down. And that's supposedly what's happening to housing costs. I mean, basically a third of the CPI is some guy guessing what his house would rent for.
When that guy has no intention of renting out his house and they're not calling landlords.
So they're using a rent that nobody pays and saying that's housing costs. Well, why don't they actually use the rent that people really pay? I mean, that's easy. You don't even need to do a survey. Just go on Zillow. You could look at what the rents are and compare to like the year before and know how much they went up. Right? I mean, most landlords, they advertise what their vacant places are renting for. It's not, you don't have to do a whole survey to figure out, or if you want to use housing prices, because when they go back and they say, oh, this is the worst inflation, since 1982. But what they don't tell you is in 1982, house prices were in the CPI. They're not in it now. So it's an apples to orange comparison. I think, personally, if we measured prices now the way we did in the 1970s, 2021 would be the single worst year for inflation, meaning the most, that we've ever had. I think it's higher than the 13.5% CPI increase from 1980. That was the high water mark, 13.5. I think we're probably about 15% for 2021. So worse. But of course, where were interest rates in 1980? 20%. Where were mortgage rates? I don't know, 14%. We were actually trying to fight the inflation back then. We're not doing anything now. We're still claiming it's going to resolve itself. So imagine how much worse this thing is going to get. If we're already worse than it was when we were fighting it our hardest at the end of the 70s, we're already that bad now, and we're just getting started. We're really doing nothing.
There's Peter Schiff, ladies and gentlemen. To hear his weekly musings, make sure you're subscribed to the Peter Schiff Show, wherever you hear your favorite podcast. Peter, always great to hear from you. Thanks so much for your input today.
Oh, my pleasure. Always great to be heard from. And again, if you want to hear more from me, it's schiffradio.com. Or on YouTube. I put all my podcasts up on my YouTube channel.
Good stuff. When we come back, you're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get all you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2022 Goals Retreat, January 7th to 9th in beautiful Lake Las Vegas, Nevada. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events or call 888-489-7723 extension 18 to reserve your spot. Get your life back on track, physically, spiritually, and financially. Attend the live in-person 2022 Goals Retreat on the second weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723 extension 18 today. Hungry for more real estate investing ideas? Here's 2 steps you can take today. First, go to realestateguysradio.com and sign up for our weekly newsletter. You'll get access to a continuous feed of thought-provoking commentary specifically for real estate investors, while also focusing on broader picture economics. Then, once you're at our site, look for the Resources tab, where you'll find our amazing collection of special reports. Browse dozens of white papers, webinars, and market reports, and request the ones that appeal to you. What are you waiting for? Head to realestateguysradio.com to implement education for effective action.
Hi, this is Dennis Waitley, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you're not 100% clear on how 2022 is going to be your best year yet, then there's still time to get you out to create your future. Our goals retreat that happens at the beginning of every year. It's the first full weekend of the new year, January 7th, 8th, and 9th in Lake Las Vegas. If you want the details, go to the website at realestateguysradio.com under events. We're talking today about what the Fed moves or proposed moves are going to mean for real estate investors. And I always learn something and have my brain stimulated when I get to talk to Peter Schiff.
Yeah, I remember when I first started listening to Peter, and of course the impetus for that was having gotten hit really hard in 2008, blindsided, and going out on a quest to find out who knew this was going to happen, you know, and did they get it right? Did they get it right for the right reasons? And we discovered Peter's book, Crash Proof 2.0, which was really an update of his original book, Crash Proof, which he wrote before the financial crisis. Crash Proof 2.0 came out after the crisis, saying how everything he said was going to happen happened. And then his follow-up book was The Real Crash, which was saying the real crash that I've been concerned about hasn't happened yet. It's going to be the result of what the Fed does in response to the crash that he predicted in 2008. And so this has been a slow moving train wreck, if you will. And the one thing about Peter is Peter has been consistent. He takes a lot of flack because everybody has ADD and they think, oh, well, you know, Peter, you've been saying the dollar is going to fail and the gold is going to go to 5,000 and the stock market's going to crash and foreign stocks are the better place to be and the U.S. stock market is in trouble. And his rebuttal is, yes, the principles under which I believe all those things to happen continue to exist. And so it's inevitable that at some point that's going to happen. Our friend Mark Skousen would say, yeah, but look how much you've missed out. Peter's rebuttal to that is, you know, better to be early than late. Okay, well, so who knows? But I do know that every time I've listened to Peter in the beginning, I had to really, really stretch. I'd listen to him and he'd go so fast and he was so smart and so deep. I'd be like, oh my gosh, I'd have to go study to figure out what it was he was really saying. I'm happy to say now I track with him much better. So if you're in that camp, congratulations. You've been working hard and doing your homework because Peter remains brilliant. If you're not there yet and some of this went a little bit over your head, let me just encourage you as kind of a layman economist, a guy that has learned this and been able to test my knowledge against some of the smartest people in the world, because we have these wonderful opportunities to hang out with people like George Gammon and G. Edward Griffin and Peter Schiff and other folks that are just Doug Duncan. Oh, and Richard Duncan.
Yeah, and sometimes Dunkin' Donuts.
So the really smart people. And what I found out is that I'm beginning to understand the way the system works. And I've also figured out, I mean, even sitting on the panel with Rickards and Danielle DiMartino Booth at NOIC. I mean, I felt like very unqualified to be on the panel, but at least I understood what they were talking about. And somebody felt good enough about my understanding to put me on that panel, right? So the point is that if you're out there and you're struggling to understand this stuff, let me just reassure you, it's worth your investment, and you can understand it because I've learned to understand it. It doesn't mean any of us know what's going on. They all have differing opinions, but at least you're in the game and you can then look at what's going on. Personally, I don't think the Fed can raise rates. I think they can talk about it. They might toy with it a little bit like they did back in 2016. I think my personal belief is saving the financial system is more important to them than saving the dollar. And I think you're going to see a lot of effort to try to replace the dollar. So what I'm watching for is how realistically are we moving towards something other than the dollar, whether it's the Fed coin, a Fed digital currency, SDRs, if you will, at the world reserve currency level through the IMF, some of the things Jim Rickards talked about in his great series starting with Currency Wars, or do we see them actually start to raise rates? Do we actually see them begin to do that? And how is the market going to respond? Are other people going to step in and buy those bonds? I don't know. But I think from a practical perspective, as a real estate investor, interest rates are fantastic right now. Real estate is a real asset that people are going to need in any economic environment. If you buy the right property in the right market, serving the right demographic, structure it with long-term cheap financing, put some other things on your balance sheet like precious metals and other things that have the opportunity to respond if the currency continues to get weak, then to Peter's point, over time, the assets will make the debt smaller because of the loss of purchasing power in the dollar. If you have gold at $5,000 or $10,000 an ounce, it takes a lot less gold to pay off the debt so that you can own the real estate free and clear. So that's kind of the game right now. I think debt is a great tool. Peter mentioned that. We've been singing out of that songbook for a long time. There's no better vehicle for getting into safe debt or safer debt than real estate, because you get the income, you get the tax breaks, you get the asset, and you get income that's denominated and affected by dollars and inflation, which means over time your rents go up relative to your mortgage payment. I don't know. We could be at the top of the market. It could keep going. I don't know. But if it's structured properly, you can weather that storm, as many people did, Ken McElroy among them, in 2008.
Real estate investors tend to be a little myopic, right? We look at the markets we're in. We understand tenant landlord law. We get, properties and improvements we can make. But I think there's a lot of real estate investors that don't step back often enough to look at the big picture, which is why we do shows like this. So congratulations if you've made it this far. A couple of resources for you if you're just confused about how all these things interact. The first is an amazing video series that we filmed, including incredible people like Peter Schiff and Robert Kiyosaki and Ed Griffin, and the list goes on, called The Future of Money and Wealth. If you'd like information about how you get your hands on that 14 hours of awesome economic content, just send an email to future@realestateguysradio.com. And the other thing that you just spoke about, Russ, and of course Peter mentioned, was gold and silver and precious metal. And I know it took me a while to get my mind around where the metals fit in the portfolio, but I am firmly there. You've been there a long time. If you're new to precious metals, especially as a real estate investor, Russ did a great series with our good friend Dana Samuelson, who is a precious metals dealer, and it's very instructive, but it also starts at the beginning. So if you haven't figured out the metals, it's free. Just send an email to silverseries@realestateguysradio.com, silverseries@realestateguysradio.com. Part of, I think, the direction that real estate investors need to understand, the clues that we get are things from, the Fed, mortgage rates, and so on. But there's this overarching question about where we're headed. All this stimulus and money printing has created trillions of dollars. Where has that shown up? In the value of your home and every home around you. I'm betting that if you're listening to this show, that your real estate market is up. But is it really? It's not up in utility. Those houses that you own don't sleep any more people. but the price is up because of all this printing. So, Russ, I know you've been speaking at a couple conferences lately about, inflation, deflation, stagflation. In our final moments, what thoughts do you have there?
Well, some people want to figure out which one of those three are we going to have, and I make the argument that we can have them all at the same time, which confuses people. But, if you look at deflation as lowering prices, well, I'm not sure we'll have that. But if you look at it in terms of slower activity, if you look at it in terms of a receding economy, then yeah, I think that can definitely happen. At the same time, numbers are going up because let's face it, if you're making $100,000 a year, but you need $300,000 a year to live a middle-class lifestyle, then that $100,000 a year isn't what it once was, right? 30 years ago, if you made $100,000 a year, you were upper echelon. Today, I just saw a study that said in San Francisco, if you make $300,000 a year, you're lower middle income. That's what you need just to have a little apartment somewhere.
Wow.
And so that's what inflation, deflation kind of look like when they're together in one place. Stagflation is really when the economy is stagnant. And the way I illustrate that is you can have nominal growth. You got a company that's making sales and they're selling whatever they're selling and the price goes up 20%. Then they're going to lose maybe 10% of their market share. And so if you do the math, like on a $100 million company, now they're doing 120 million, but they lose 10%. Now they're doing 108 million. Okay, well, on paper, it looks like they went up 8%, but they laid off 10% of their workforce because they're really actually selling 10% less and they're producing 10% less product for the marketplace. And now the marketplace has shortages. And that's what stagflation is. That's all it is.
And by the way, if their price of their product has gone up, probably so have all the components of that product.
Yeah, so they're not making more profits. I mean, they're making less profit. So there's less profit, less productivity, less jobs, and yet the number gets bigger. That's how inflation distorts markets. And obviously, when you add to that the insult to the injury of lockdowns, where you break up supply chains and you stop productivity, just giving people money to spend without balancing it out on the supply side, well, of course you're going to have higher prices and shortages. So the question remains to be seen in the market we're in. Will the supply chain issues abate? Will those things get reinstated? Here's the challenge with that. When a business fails because of a lockdown, it doesn't just come back. It's not like a light switch, right? That entrepreneur is gone. They're wiped out. And the capital and all of the labor and all the effort it took to assemble that business and it caused it to be productive is gone. It just doesn't come back overnight. And so it can be a boon for those businesses that remain, but whether they can scale quickly enough. And so there are some serious issues. We talked about this and we're promoting various series that we've done over the years. But when COVID-19 first hit, when the coronavirus first hit and everything locked down in the beginning of 2020, we invited Peter Schiff, Ken McElroy, Daniel DiMartino Booth, Tom Wheelwright, just all the smart people that we knew. We didn't know what the heck was going to happen, but we said, let's interview all these smart people and find out. And let's go ahead and record it all. And let's give it to people for free. That is still available. If you send an email to crisis@realestateguysradio.com, you can get that and you watch that whole series. And of course, it may seem a little out of date. And yet, if you really can understand when you study the past, that the past can help you understand the future, I think a lot of the things those folks were talking about were going to happen did. Some of the preparations they said you could take, you still can take. We added context of the time that's passed. We're not out of the woods yet, right? They're still talking about shutting things down. This thing is still floating around out there. I think all of us are kind of over it emotionally, but I'm not sure that we're over it from a policy perspective and the impact of that policy on Main Street. So these are all things we need to continue to pay attention. You can't grow weary of paying attention just because it's dragged on. Just like you can't grow weary of listening to a warning siren like a Peter Schiff just because the asteroid hasn't hit the Earth yet. If it's, 200 million miles away and it's coming, it's still coming. And I'm not saying it's going to be the end of the world, but it could be a major sea change in the way the economy works and what investments work. And you have plenty of time to be making preemptive adjustments and get positioned, but you can't be asleep at the wheel and just think you're going to wake up when it's upon you and get everything in place. So if you're really, really serious about this, if you really want to do something fantastic in 2022, then sign up and come to our Investor Summit. because we're going to have, hopefully Peter, but we're definitely going to have George Gammon, who if you're not following George Gammon, you should be. We're going to have G. Edward Griffin, wrote The Creature from Jekyll Island, who really understands the Fed and that policy. We're going to have Ken McElroy, one of the most successful, prolific investors there are, an extremely nice guy, and he just speaks in common sense language, plus a couple hundred of real life investors that are out there every day that have been soaking this stuff up for quite a while. And of course, we'll be there. We go deep. We're there for like 7-8 days. We do long sessions. We stay up late. We get up early. We talk about this stuff. You can't replicate that on a Zoom room. You can't replicate that watching YouTube videos. You have to be there. And there's only so many spots. I don't know how many are left, but not a lot. So if you think you want to give yourself a great Christmas present, if it's not too late, or kick off your new year with a promise to yourself, then make plans to join us on our Investor Summit. Just send an email to summit@realestateguysradio.com or go to realestateguysradio.com and click on the button that says Summit. Get all the details, but don't wait. We can only hold about 250 people, and last year we had to turn people away. So it doesn't pay to procrastinate on something that important or preparing your portfolio for what might happen. So there's a lot going on in the world. Congratulations on paying attention. Take it to the next level and join us on the summit.
Our friend Peter Schiff has been on the Investor Summit 8 of the last 9 years. And after our interview, he said, hey, we really want to come back this year. So that's not a commitment, but there's an excellent chance that we'll see Peter and get to pick his brain for 8 days in a row. Hey, big thanks to Peter Schiff for taking time out of his crazy busy schedule to share with us, and congratulations for being interested enough in not just little greenhouses to learn more about the big picture that affects us all. As we continue in this holiday season, we wish you and yours an amazing and awesome time, and we look forward to an incredible 2022. Next week, we'll round out the year talking about financial strategies when it comes to real estate investing. Until then, happy holidays. Go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.